morning. This is Dylan Jovine from Behind the Markets. Today is Thursday, August 1st. Wow, a lot of stuff has happened since I last visited with you. The Dems got a new presidential candidate. Wow. CrowdStrike basically caused an outage that stopped airline traffic, which, of course, while I was traveling in its tracks, and that caused me to have to spend 24 hours getting back from Greece to America. Israel killed, a Hamas political leader and a Hezbollah leader. Gosh, that looks like it's going to just right on the verge. It's like Tinder, Tinder that's being lit. It's crazy. I mean, wow, a lot of stuff has changed. But one thing that hasn't changed is, all the talk about the Fed rate cuts. I mean, yesterday the Fed released minutes and, a lot of talk about interest rate cuts. And, I wanted to spend a minute here talking to you today about what happens to the stock market when the Fed cuts rates. Wall Street, if you look at the CME group, their FedWatch tool, they say 93.3% of market professionals or participants are expecting a quarter-point rate cut in September. And that's great, and people get very excited about that. But what actually happens to the stock market when the Fed cuts rates? I mean, most people think that the markets automatically go higher, but that's actually not true. If you look back at the data going at least to 1994, when this was really started, quality tracking of this data, what you'll find is the S&P 500 is actually a below average performer in the 3 months and the year after the Fed starts a rate cutting cycle. And even more interestingly, it actually is down a little less than 1% in the week after the Fed begins to cut rates, actually down 0.7%. So why does that happen? Why does the market tend to go down when the Fed initiates a new interest rate cutting cycle if lower interest rates are really good for the economy? Well, they are good for the economy, but this stock market that we're in actually gives us a big clue. And the big clue is this. All market participants expect a Fed cut in September. So that's been priced into the market. I mean, this market has just marched right up and is trading right there as if there is going to be a Fed rate cut in September. Now, I actually don't think there should be a Fed rate cut at all. I actually think the Fed should leave interest rates where they are because, look, housing prices, most Americans can't even afford housing prices. And what that's starting to do is you're starting to see housing prices really start to come down. So if you cut interest rates, that'll stimulate housing activity and they're just going to keep going higher again. I have no idea why the Fed would do that. Also, there are so many retirees out there that are actually that are actually sitting on money that are earning 5% or thereabouts in interest on their accounts now. And if the Fed starts cutting rates again, what that's going to do is penalize saving. It's going to push people who otherwise would save or have an incentive to save. It pushes those people to spend money, and it pushes investors to actually take grosser and grosser risks. And an example of that is, certain AI things or crypto or whatever, just chasing low return, the low interest gets them chasing returns. I actually think that we have a pretty good economy. 4.1% unemployment, housing prices starting to come down, retirees can put their money in a federal money market fund and get around 5%. I mean, to me, this is Goldilocks right now. I don't know why you'd mess with this. I mean, this looks pretty good, and they're still not at their inflation target that they keep talking about. So, again, I'm in the camp that the Fed should not cut rates. This is actually a sweet spot economy. Look at unemployment is great. People are earning, savers aren't being penalized. Retirees aren't being penalized for having saved all the money and did everything that they were told to do their whole entire life. You figure, hey, save money and put it in bonds so when you retire, you can earn an income. That's been the narrative that all these baby boomers have been told since they were working, since the 70s. And you know what? The deal really changed on them, which makes it very, very difficult. So these baby boomers who really should be collecting income, safe income every month, have had to actually go out and try to figure out how to earn money without destroying their retirement funds. So that's been very, very, very tough. And that's obviously done a lot to twist and distort, economic value in certain areas. Anyway, so this is my first official day back. I mean, I did come back a couple days ago, but after 24 hours of travel, I mean, I was like punch drunk. You know, I couldn't even see straight. So I just wanted to say I am grateful to be back, and I'll speak to you again tomorrow. Have a great day.